I'd like to welcome you here to the program. For today, we want to look at capital budgeting. Capital budgeting. It's a very popular topic in finance. And more importantly, we're going to look at how to use analytics to do this with an analytic mind. But for those who do not have prior knowledge about this, capital budgeting has to do with assessing the long-term viability of any purchase or any product that you launch or any operation that you expand. And that assessment is based on the financial returns and the current cost of that. I'll give you multiple examples for you to appreciate capital budgeting. One of the things I've realized is that a lot of people do not budget. Forget about finance, even in our normal daily life. For example, there is a holiday ongoing, and so many people are going to spend haphazardly. But some people have actually budgeted before they are spending. They have been eating less, consuming less, and therefore they have saved more purposely for this. And so if you follow them and then you look at their trajectory, you notice that you are wasting money now, even though you are spending just as they are spending. Capital budgeting is very, very important. Now, what are the steps to capital budgeting? How do you budget? Well, the first is to identify the opportunity that you want to go into. Evaluate the cash flows that are coming per period. Select the particular technique that you want to use, whether it's a net present value, internal rate of return, modified internal rate of return, payback period, profitability index, and several others. After selecting, you do the risk analysis, and then you make a decision on the investment, whether to pursue it or not to pursue it. Now, using multiplicity of these techniques will help you to make a decision as to whether, so you don't use only one. And then from time to time, you monitor, you plan and review. You monitor and review to see whether the decision you took is sensible. So let's take the first approach to capital budgeting, and that is net present value. We have been looking a lot at the present value of the future, the present value of a future payment. And we've looked at even the future value of a present payment. So what is the net present value? It's a very simple thing. What you do is that you compute the present value of future cash flows, compare it with the initial investment, you take a decision. So CT here are the cash flows for that particular time period. So if the time period is 0, okay, you have C0. If you have time period 1, you have C1. Time period 2, you have C2. You divide that by the discount rate given the time period. You sum all the present values, that is the summation symbol here. And then after that, you subtract whatever you have, the total, the sum. Okay, you subtract the initial investment from that. What you have left is a net of the present value. The CT is a cash flows at the time T. R is a cost of capital. The C0 is the initial capital, and T is a time trend. Okay. Now, where do you decide? The decision rule is very simple. If the net present value is positive, you accept the project. Otherwise, you reject the project. Let's take a typical example. We're going to work this in Python, particularly in Jupyter Notebook. Elzo Construction Company is considering putting up an office building that requires an initial investment of 1.5 million Ghana. The project is expected to generate a cash flow of 2 million in year 1. If the company required rate of return is 35%, what is the present value of this project? Should a company accept the project? Should they reject the project? What would be the present value if the interest rate changes from 35 to 12%? So let's try to look at this by going into our Python. So you all have this. This is example 18 that you all have. So how do you handle it? Well, the first thing you want to do is to identify the element. The cash flow for the first year, year one, is 2 million. The initial investment is 1.5 million. The interest rate is 35%. Now, we know that you always have to import the NumPy underscore financial as NPF and then use that to define. How would you have proceeded with this? Who has a guess? How would you have proceeded with this? You have to use the formula that we normally have. Remember that formula, the net present value dot PV. Remember, of course, you need to identify. So after you've written this, the first thing you want to do is to write the cost of the investment. What was the cost of the investment? It is 1.5 million.
1.5 million.
So you write 1.5 million. And then you come to the next one, which is using the NPVF principle. You can call it X. So let's say X, and then we use the NPF dot PV. You know this formula that we've been using all along. You write the rate, indicate the rate. Then you write the number of period, NPR. You indicate that. Then you write the payment, a PMT. You indicate that. And then, okay, so I'm going to leave the payment. The payment is actually going to be 0. Then the future value, we are told that you will generate a cash flow of 2 million. So the future value, which is this, you indicate that. And then finally, your when, you indicate that. Okay. So what will be the rate? What will be the rate? What is the first one? The rate, the interest rate, the rate of return.
0.35.
Very good. So that is 0.35. What is the NPER, the number of period? How many years are we dealing with here? 1. Okay, 1. We are dealing with 1 year. And then the payment, well, for this, there was no payment. So the payment is 0. What is the future value? The future value, as you can see, we start from today, okay, it will generate a cash flow in the future. By the end of year 1, it will generate a cash flow of 2 million. So the future value is going to be 2 million. So 2 and then 6 zeros. And then when? Now you remember that we always write begin. And we said begin is number 1, and then end is number 0. So I can also use 1 to represent the when. Okay. Now you can do these one by one, or you can do them at a go. So now we have all of this. So what is going to be our NPV? The net present value is going to be our X we are going to calculate, because it would have taken all of them cumulatively, the sum. So it's going to be this X value that we would have gotten from here, and then minus the cost, the initial cost, which in this case, you have already labeled it as cost. So you just have the cost. And then you can print your result. Now, there are multiple results you can print. You can print, okay, your cost. You can print your X. Okay. and you can print your NPV. What did you get? Who can tell me what you got for your NPV? I was waiting to see you, somebody do it. So what did you get for your NPV?
Yes.
You know, I can give you the answer, but it won't help you. But you should understand what we are doing. If you don't understand, you should always ask.
It got 18.5.8.
What did you get?
Got
Oh, you should
18.
make the NPV negative. Okay, I must say that because it is something that is in the picture.
Okay, I rather made the cost negative.
You rather made the cost is already going to be subtracted from the NPV anyway.
So I didn't negate my future value.
Other than that, you have to make a plus in the NPV form.
Okay. But
But you should get approximately the amount you are seeing, the 18,518. That is your net present value. So based on this, would you undertake the project or you will not undertake the project? Should we undertake this project? L4b Construction Company. Should they put up the office building? Hmm? Who is talking? Godwell.
hold up.
You have people talking in your background, right?
Yes, sorry.
All right. So since it's negative, we undertake the project. So that's a very basic way of undertaking net present value. Okay. Any question on that? Let's look at another example. This time you have multiple cash flows. Okay. So let's look at the next example. A company is considering a project that requires an initial investment of $50,000. The project is expected to generate the following cash flows over the years. In year one, it will generate $15,000. In year two, 18, year three, 20, and year four, 22. What is your work? Well, if the company's required rate of return, the interest rate is 10%, what is going to be the net present value of this project? Should a company accept or reject the project? Guys, you have the information with you. I want you to work it out and tell me whether the company should accept or reject the project. What is the first thing you think you have to do? What do you think is the first thing you want to do? Oh, hold on. The previous question, it was asking you what happens if the interest rate changes. If you look at this, it says, what if the interest rate changes to 12%? Okay, so you have to come back here and change everything. Okay, run the next one. I didn't do that. So you change the interest rate from 35% to 12%. Everything else remains the same. And now you can see that the interest rate going down will increase the net present value. It moved it from negative to positive. The net present value was 18,000 and now is moved to 28,000. So what is your conclusion? Okay, you can type your conclusion here. If I were to add another cell, okay, you can just, let me put it in also in a markdown. You can now type your response, okay, and just say that reducing the interest rate increases the NPV. That is basically what it does. And you can see that. If you like, reduce this interest rate further to 5%. So let's do 0.05, 5%. That 28,000 will go up. And you can see that now you have 40,000 as the next present value. So clearly, reducing the interest rate will truly increase the net present value. Does that make sense? Absolutely. Because once you cut the interest rate, that is a cost of capital. So the cost of capital in undertaking the project is going down, and therefore you are, or the weighted cost of capital, the WACC, is going down, and so you've got a higher chance of getting a return. All right, let's go to the multiple cash flow. That one was a single cash flow. So multiple cash flow, how do you go around that? The same thing. This time the interest rate is 10%. Okay. So the first thing you want to do is to create a data frame of the information you have. So guys, I want you to enter the information. I've just left some of them for you. So the first one is 15,000. That one has been written. The next one is here. The next one is there. The next one is there. Substitute them to get the DF. And let me see. So if you run that, if you do 18,000 for the second one, the next one is 20,000. Before you go to the last one, which is 22,000. Remember, we are creating a data frame, with a pandas library. And so when you write CFs, that's the name we want to give. That's a column we want to give. And then these columns, the information are 4 rows. And so the next column, which is a year, is 4 as well. So that will give you each one of them in a kind of a beautiful table. If you want to know what I mean, you can just come down here and just write the name of the DF. Okay. Okay, so sometimes you have not installed the pandas. So it's important that you ensure that you have installed the pandas package there. Let's do that. So let's go and type import pandas as PV. Okay. And now let me run this. I'm just taking this off and just trying to show the results again. The name is DF. Oh, did I do that? Let me be sure I'm on track. PD. Okay, let me just print. Hi guys watching.
Yes.
I have so many things to show for them. All right. So let's continue because I don't even need to show it now. I don't need to show it now. Okay. So let me just continue. So you have the initial payment. What was the initial payment up here? That is $50,000. So the initial payment, you fill in that. If you are doing this yourself, you have to write them yourself, $50,000. Okay. And what was the interest rate? The interest rate is 10%. So you do 0.2. Okay. And now you have to define your present value. Okay. Now for each one of them, you can see that from this data frame, we are creating the present value divided by 1 plus the interest rate. Okay. And then you have raised to the power the time period, just as we normally have it for the calculation for each one of them. Okay. If you were to remember the formula for it is 1 plus r raised to the power t. Okay. So that t is what you see as this. That t is what you see as this raised to the power years, because the years have been defined right here. And so once you've gotten it, this is a calculation for each present value. Then we create the total of that, which is each of the x multiply. Okay, we create a sum of that. First of all, we create a sum of that. And how do you create a sum of that? So first thing you want to do is to generate the sum to get a y, and the y is x dot sum. That will give you the total value. And then you can now have the present value. The present value is basically going to be the y that you have minus the initial investment that you have. So this y, you type it there, minus the initial investment here. And the initial investment, let me double check, is 50,000. This is also 50,000. We substitute the word initial investment. And then we can show the results that we need to show. Now watch here carefully. We are going to show the data frame, then the x value, the y value, and then we'll print the net present value, correct to 2 decimal places. We'll also print a statement indicating that we've rounded it. And then we'll come and talk about the decision rule. The decision rule is very simple. If the net present value is positive, then print out the statement that the project should be accepted as since the NPV is positive. Else, so we are using the if else command. Else, if the present value is, that is, if it is not positive, that is, if it is 0 or negative, then we indicate that otherwise. So this thing is not running. Let me just confirm why. Because it's supposed to. So when you work it out nicely, you're going to get this result. For the data set, you're going to have it like this for the data frame. And then for your X value, you're going to get this. For your Y values, and then for your net present value, you're going to get that. Of course, this is positive. So the statement has already been taken that the project should be accepted since the net present value is positive. Okay. So that is how you got to attack this very question. Now, the next thing, wow. The next thing is to create a net present value profile. Okay. You're going to create a net present value profile. Now, how do you understand? Because when you go back to the question was very explicit. It says that the project is expected to generate the following. And that towards the end, should the company accept that? Now, if you come here, we're going to learn how to create a net present value profile in Python. So we're going to do the same thing that we started with. Now, to create this profile, and I'm sure you have it. I hope I gave you this command. To create this profile, you need to import NumPy as NP, matplotlib.pyplot. Okay, so these two packages, you import them. Now remember that we've already calculated this, but we're going to redefine them for the purpose of this graphic. So we define and calculate the NPV, given the initial investment and the cash flows, and then the discount rate. We are creating our own definition. Because my testing is not working, I'm just showing you the one I've already done. So the NPV will be the negative of the initial investment, okay, for time t with a cash flow, which is iterated, starting from 1. You can now calculate the NP value, and then you can tell it to return all the results. So whatever data that we originally have, we can put them into this. Our initial investment as originally was 5,000, 50,000. The cash flow, as we know it, were this. They are already up here, 15,000, 18,000, 20,000, and then 22,000. They are all here. So these are the cash flows. Now we can define the discount rate. Now this very discount rate, we can give it a range, okay, with 100 points between 0 to 20%. And then we can create the net present value that we originally calculated. It's the same thing because we've already defined the calculation here. So this calculation is coming from what we have already defined. The initial investment is there, the cash flows, the discount, everything is there. Okay. Now we can plot the NPV profile. And you're going to see the profile. These terms are very simple if you know how to do some of these plottings. They're very simple. So we plot the discount rate in percentages, the NPV values. We label the axis as NPV profile. We give it a color. And then on the axis line, we indicate where Y is starting from, the color, the line style, everything. We indicate the X label and the Y label, and then the title. We request for legend, the grade, and then a show. So the grade is there and everything. So this is the NPV. Okay. And then you can see the 0. What does this mean? Oh, by the way, you should run yours because I've done it already for you. Okay. What does this mean? Remember that our NPV that we had was 8,564. So we have 8,564. So on this level here, we will have 8,564 somewhere above the red line. And you will notice that at the point where NPV is 0, that is when the interest rate is almost 17%. Okay, so the discount rate will be almost 70% at that point. We'll come to the internal rate of return to understand that. But you can see from this graph that as the interest rate is increasing, as the discount rate is increasing, the net present value is falling. Or as the discount rate is falling, the net present value is rising. So that gives you a profile of this project. So if the interest rate is at a certain level and you want a particular net present value, you should be. So let's say that the interest rate is at a particular level, say 10%, and you still want a positive net present value, then you know what you can do to be able to get that positive net present. So this is basically how to generate the profile. Okay. Let's take another example to be able to appreciate what we are doing. And I'm sure you have this example 20. Let me just confirm you have it as well. Yes.
Yes, please.
Okay. You have example 20. Okay. But the key point about the profile is that the net present value profile, what it does is this. If you check it carefully, you will see that it is showing you how the net present value changes with the different discount rate. So you're able to visualize the sensitivity of the project to different required rates of return. You're able to see that. And how you normally do it, which we did, is you define a range of the discount rate between 0% to 20%. And you can see that in our case, we have that between 0% to 20%. That is the range of the discount rate. Then you calculate the usual net present value for each discount rate that you have. And then after that, you can plot the profile using the math plot lib. So that is how you go ahead in doing that. Let's take this example. This time I'm going to let you do it yourself, and then you tell me. So assuming you have the cash flows from the construction and sale of an office building is as follows. Okay, so year 0, you have negative 1.7 million. Year 1, you get negative 1 million. Year 2, you got 3.2 million. Now, given the interest rate, the required rate of return is 20%. Create a present value worksheet and then show the net present value, okay, and then create the net present value profile. That is, draw the graph here. So I've given you a template on how to go around this. Let me see if I can show you that template. Oh, your own. Where's your own? I can't find it. Which of them do you see? Yeah, you have it there, right? You have it there, here. So this is what I've created for you. So I want you to fill in the information here. All of you, do that. So the first thing is, given the question that I've given you, okay? Given the question that I have provided for you, which one am I showing? All right. Given the one I'm showing you, I want you to, it looks like I've already done these things for you. So use this to generate the results and tell me. Right now, because I have 2 of these things running, I don't know exactly which ones I'm running. Oh, no. Hold on. Yes. I think I've done it. I want you to run it. I've already done it for you. I want you to run it and show me your results. So one of you should run and confirm with me whether you've been able to get your results. What range did you use? The previous example that I did, I used a range of 0 to 20 for the profiling. What did you use? What is this one using? For the discount rate, the range of the discount rate. Given the template I gave you, what did this one use? Do you all have the codes?
Yes, please.
Okay, good. So if you have the codes, you can run. Since mine is not showing, I want you to run yours and let me know what was the range of discount. All right. So when you do that, you see that the range of discount is from 0 to 7. Okay, 0 to 7. Okay. And then you will now be able to get something that looks like this. You're able to get something that looks exactly like this. unlike the previous one, you'll be able to get something that looks like this. That is how you are able to generate your profiling. That's basically how you're able to generate your profile. Now, if you check your net present value, you will notice that you're going to get a negative 39,000. Okay, a negative 39,000 with that interest rate of 20%, which means that the project is going to yield a negative result. When you create the profile, you're going to get something like this. And you can see clearly that we are in this section of negativity as well, okay, as you can see from even here. All right. So that discount rate, that leads us to the next point of what is that discount rate? What is the internal rate of return? The internal rate of return, or the average rate of return on investment, it complements the method for valuing the investment. Okay. The internal rate of return is defined to be the range of the discount rate, which is between 0 to 20 or to 100. That will make the net present value of the investment 0. Yes, set. Set your hand.
The data frame for the previous question we solved, I think the last year value was 4 million. Meanwhile, in the question, it was 3.2. I don't know if you were doing experiments with it or
Yeah,
I'm not seeing it.
because I was experimenting.
Okay, then I'm fine, sir. Okay, thank you, sir.
All right. So what interest rate will make you break even with a project? That is the internal rate of return. What is the interest rate that will make the net present value of an investment 0? That is a discount rate. That is the internal rate of return. So what is the criteria for using IRR to make a decision? Well, if an investment should be undertaken, then the internal rate of return must exceed the benchmark return needed by the investor. That is only when you can say that this investment is a laudable investment. When you use it correctly, the internal rate of return will lead to the same conclusion as the net present value. So if the net present value is positive, requiring that the project has to be taken, the internal rate of return must exceed the benchmark for the same thing to happen. Okay. So it should lead to the same thing. We're going to take an example of a huge project, and then you're going to calculate multiple things in that project. Now, this question is also in your analysis. So it's in your analysis. So I'm not going to show it. I'm going to show it rather in your own. Where is your own? All right. I'm sure you can see. So this is a project. Now, remember that when you are calculating this, if you are calculating the internal rate of return, you must use this code. Remember, it's the same thing. Okay, the internal rate of return is IRR into bracket the values or the cash flows that you have. That will give you the internal rate of return value that you're looking for. Later on, we'll look at the modified internal rate of return. And that one is the same thing as the previous one, but the modified one, you bring the values, then you bring the finance rate as well as the reinvestment rate, which I'll explain that. But for now, let's take an example that will require you to calculate the internal rate of return. So let's look at a question. A student is considering pursuing 2 mutually exclusive projects. And what do we mean when we say 2 projects are mutually exclusive? What do we mean? Anybody? What do we mean when we say that 2 projects are mutually exclusive? It means that they cannot happen at the same time. Okay, you can't do both at the same time. So the projects are MBA projects That's a project A or MPhil project. Now, the tuition fee and the incremental earnings every year after completing the course are shown below. So if you're doing the MBA, okay, we are just assuming that it's 4 years. If you're doing the MBA, which is a project A, the initial investment is negative 50,000. The MPhil, the initial investment is also negative 50,000. In year 1, after completing the project, the return you're going to get is 15,000 for the MBA, 10,000 for the MPhil. In year 2, 18,000 for the MBA, 14,000 for the MPhil. In year 4, 22,000. Then MPhil is 28,000. Assuming that the required rate of return, that is a discount rate, is 10%. Find the net present value for both projects using that 10% discount rate. So you got to do it for each one of them. After that, calculate the internal rate of return for both projects. This is simple to do, but it is time consuming to do, but you got to do it. Then you compare and decide which project the student should go for, whether to go for MBA or to go for MPhil. This is the interesting part. You draw the graph comparing the net present value profiles for both projects. And it must show the net present value is changing with different discount rates as we have done previously. Okay. And you should also mark the internal rate of return of both projects. You should mark it, vertically mark it. And then indicate whether there is a difference between the graphs of the internal rate of return profile as well as the NPV profile. So you're going to draw the IRR profile and then the NPV profile, or the IRR graph and the NPV graph. You do all of this in your exams. So it's important that you know what is going on. So how do you do all of these mumbo jumbos? How do you attack it all? Well, there are a few things to note before we start. I want to see what I gave you actually. Okay, so actually what I gave you is not there. So the first thing you got to do is this, and you want to do it whilst I show you. You want to import NumPy as NP. That's down here. Okay, it's down here. So take note, write it. You want to import NumPy as NP. So go down there and then type that. And then, of course, you also want to import Solver. But there will be some optimizations that will do that, which is the second command. Let me know when you are done with any one of them. Now you define the calculation of the NPV. And this one is from the previous one, so you can copy the previous one, okay, and just show it. We'll do some few changes. Define the calculation of the net present value. That will have an initial investment, that will have a cash flow, that will have a discount rate. Remember to bring a column, and then with your triple quotations, indicate that this definition will compute the NPV for any given discount rate. It's just a matter of copying the previous ones, all that we've shown. Okay. All of these are self-explanatory from the previous one because it's just calculating the. So you got to realize something, that normally you need to have that net present value computed. From that, you can get your IRR. So that is for the net present value. Now let's define for the calculation of the IRR. So like I said, this one, you will get it already. This one, few changes. It's the same thing as the previous one, but you're changing some few things. You're defining the IRR, the same initial investment, the same cash flow, which you are copying and pasting. And then that statement that you wrote that is computing the net present value is the same thing here, but this time you are computing the internal rate of return when the net present value is 0. And we know this because that is what the IRR is about. Once you've indicated that, create an IRR function. Okay. This function, which is lambda R, is going to compute the NPV. Watch it. The definition we gave to the IRR. That's it. That's the same thing you're doing here. You're calculating the NPV value, okay, which you will need first. And now, because we don't know the IRR, we are going to guess. So this is an IRR guess. We are going to guess the initial value of the IRR. We don't know it. Okay, we don't know it. So for now, we are taking a guess because we don't know the calculation. Now remember that this is 10%. That's why we are using the initial value to be 10%. And now you are going to solve, using solver to solve and calculate the function that you generated or you gave here using the guess discount rate that you had. And then it will return a solution that you can now use. Okay. The most important thing is these definitions. Once you have made your definition, now you input the data. What was the data? Well, the initial value is 50,000. So you're going to put in that 50,000. Because it's already an initial value for project A, we'll put in that 50,000. For project B, we'll also put in the initial investment of 50,000. Now, how about the cash flows? For the cash flows for A, you just put them there as they were. They're in the question there. 15, 18, 20, 22. So you do that 15, 18, 20, 22. And then for the project B, cash flows, they are also there. So you indicate that. Now, once you have commandeered, and remember, you are defining certain things, so you work with those same. Remember, the interest rate we are using was given in the question as 10%. So you indicate the discount rate. Remember, it's the NPV that we are starting first. So now let's calculate the NPV for the first two projects. The NPV for project A, which is the MBA, is going to be the definition we originally gave up there. And the NPV for project B is going to be the same definition we gave up there. Remember, we have signed this definition already here. Okay? We have done this definition already here. So that's exactly what we are using. So these two will calculate the NPV for project A and NPV for project B. Now, you use the definition you gave for the IRR as well. Okay, that one was initial investment and cash flows. You do that for project A. So IRR for project A, you're going to use the find initial investment for A and then the cash flows. And then for project B, find IRR, which is initial investment for B and then the cash flows. Okay. We are doing both of them at the same time. Now, let's print out the result. So, regarding the net present value, okay, remember that we want to know whether it is positive or negative. So, we have commanded that you should print the project A, okay, net present value, and then project A's internal rate of return. And that internal rate of return, you want it in percentage. And project B, the same thing, you want the net present value and you want the IRR in percentages. That's why you multiply it by 100. And then you also command the decision because we already know the decision. And the decision for the NPV is that if the NPV is greater than, if the NPV of project A is greater than the NPV of project B, then we'll go for project A. So the printout should be, the decision is to choose project A because it has a higher NPV. If If not, that is else if, instead of saying if not. Okay. That means if project B is rather greater than project A, then the decision will be the opposite. Choose project B because it has a higher NPV. So all these printouts will come, provided whichever one is the one. Okay. But what if they are the same? If they are the same, then print out the decision that both projects have the same NPV. So that will be the decision. So that will, of course, means that you don't have a choice. Neither project is bigger than the other. So these are your decisions. Now for the internal rate of return, that is if you need it. If a particular internal rate of return for a project, say project A's internal rate of return, exceed that of project B's internal rate of return, then we are going to choose because you want a higher internal rate of return. Okay. So the alternative decision would be to choose project A because it has a higher IRR. Other than that, you choose B because it has a higher IRR. So I want you to run this, your result, go through these processes, run this result. Let me take you back here. Run the result and let me know what you have. Because I want you to take your time and complete it and let me know what. After this, we are going to draw. This first stage is just to show you how to do the calculation. Who is on track? Raise your hand if you're on. Okay. So what I'm going to do now is I'm going to take you to my results. Because I want to believe that some of you are doing it. But since nobody is responding, I think that I will assume that. So this is what you should do. After you've gone through all this and you run this command, you're going to get this answer. So the NPV for project A is going to be 8,564. Its internal rate of return is higher and the NPV is higher. They are all positive, but NPV for project A is higher than project B. Project B is 3,300, okay? 3,309, and the internal rate of return is 12.56%, which is lower than project A. Therefore, the decision was here. Okay? Choose project A because it has a higher NPV. What about the alternative based on the IRR? Okay. So when you look at the IRR, you can also see that IRR for project A is higher. So the selection has already been made to choose project A because it has a higher internal rate of return. That's it. That is how you make your conclusion. But let's go back to the question. It says that draw. So we've answered question 1, we've answered question 2, we've answered question 3. We know which one. Draw the graph comparing the NPV profiles. That's the first one. Then also do that for the internal rate of return because it's the same thing. So remember that the internal rate of return must be marked by this. Now, this graphical approach is not a piece of cake, but it would take the initial things you've already done from here. So let me walk you through. And where you don't understand, you just ask. So the first thing, because you're going to do a graph, we bring, libraries that are able to do graphing. And this, apart from the NumPy, the Matplot, lib, and then PyPlot, and then the SciPy for the optimization process. Okay. So we are going to start everything as if we've not done that. So I'm not going to talk about this because we've already run all of this. We have run this, we have run that from the previous question. We have shown the data, we have calculated all of this. But now the whole thing starts from here. After you have given the initial investment for both projects, you indicate the discount rate. You remember we said that you always select a discount rate with a certain range. Now, why are we selecting 25? Because if you look at the discount rate, one of them was having 12%, the other was having 17%. So we are having a stretch of the discount rate a little bit. So that is why you can see that we have 0, 25%, and then 100%. For project A, how do you calculate the internal rate of return? This was the formula that we gave. It's up there. Okay. Initial, so first, you have to have the net present value calculation, okay, for the project A with the cash flows and then the usual rate, okay, for that particular discount rate. And then you do the same thing for project B. The initial investment for project B is cash flows and is discount rate. To calculate the IRR, what you do is you use this command, which was originally defined. It's up there. Okay, finding IRR. You put in the initial investment of A, which was the same value you had here, and then you have individual cash flows. You've already defined them up here. All of them are up here, so you don't need to write all the numbers again. Once you do that, you will get the value for the IRR for project A and the IRR for project B. Okay. Now, how do you do the plotting? You take the size of the plot, how you want the thing to be mapped horizontally and vertically. Okay. You plot the discount rate in percentages, the NPV values that you have. You label the project A as project A. You give it a color B. You label project B as project B. You give it color G. Okay. All of them will have their discount rate and that. And then you can now create the lines. Some of them will be broken lines. Okay. And you will have a section where the NPV value is 0. So you indicate that with the axis line for that. And then this is interesting because you're going to mark the IRR point with vertical lines. So remember the NPV is coming down. Okay, the NPV is coming down like this. And then at any point where it matches the IRR on the axis, what you want is that you want to give it a certain vertical marking. For each project, you're going to give it a certain vertical marking. And this command does that trick. Okay, so you're plotting on that axis D line, and then you can now do the marking. You're going to label IRRA for that point for project A, where the internal rate of return has been identified. And you do the same thing for project B. But this is interesting because where you have the IRR point itself, you want to highlight it. You want to highlight it by using this one. Now, what I would suggest that you do is that you go and run each one of these one by one and show, run and show, run and show, run and show, and you'll be able to get it. So you plot each one of these for each project, and then you commandeer that some legends and all of those petty things, the labelings are shown there. And then you print your result. Okay. And when you print the results, you're going to get this. It's a lot in there, but you know where you're coming from. It's a whole project. Okay. Now, the results that I indicated at the bottom here to print the result, that is what you see down here. Okay. That is what you see. That's a rate that you have that will give you the value you're looking for. I want to show you something. Remember that these were the internal rate of returns that we had there. Now, when you come here, for project A, that is a blue one. For project B, that is a green one. Okay. These are the net present value profiles. Okay. So you have that. Now, what was the interest rate we had already calculated? This was the interest rate. The one was 12%, 12.5%, that is here. That's a green one. And then the 17.19%, that is a blue one, which is there. But where is the interest rate that makes the net present value 0? Okay, and we have that because at the point of this gap here, we are able to know that particular interest rate that makes the net present value 0. So we bolding that IRR for project A and project B. And you can see that that is a point where the net present value is 0 on the y-axis. So they have also been shown there. And you can see that we have given those lines You see, the reason why project A is better is that as you look at project A at the interest rate, of that 12 point something percent, 12.56%, at that interest rate, project A, project B is zero. Its net present value is zero. But at that very interest rate, project A is 5,000. So that even goes to show why project A is better than project B. But you've been able to show all the profiling here. That is exactly what this question is asking you to do. Familiarize yourself with this. Okay. Let's talk a few information about the project. So the blue line, as I indicated, is a profile for project A. The green line is a profile for project B. The red dashed line is a NPV when it is equal to 0, the break-even line. The vertical dashed distances show where each project is located. Said that. Okay. And then the deep blue and deep green point, okay, show where the project's NPV is 0, the particular internal rate of return. We've said that there. And you can see that the IRR is where the project NPV crosses the x-axis. If the internal rate of return is below, the project is profitable. Okay. And you can see that there. So anytime the internal rate of return is below, okay, the project is profitable. And you can see that here, if below that point, okay, the project is profitable. It's positive. That's why it's profitable. Other than that, it's not profitable. And you can see that if the required rate of return or the interest rate is greater than both IRR, neither project is going to be profitable. And you can see that here. You know, for example, if you go to 20%, okay, 20%, it means that you're having a there's no positive value for any blue or green line at 20%. So that is where none of the project is viable. So that is how you calculate this very example. Okay. Let's go to another basic one. And again, I would encourage you to go and do this. Okay. Another basic one. So here you have a very simple basic one that I want you to look at. You have an initial investment of 4,000 at time 0. Year 1 cash flow is 2,000. Year 2 cash flow is that. Okay. I want you to find the internal rate of return, okay, for this project. Find the internal rate of return for this project. In fact, I've actually given you the way to calculate that. Okay, let me just show you here. So in here, I've shown you the way to calculate that. So use that to easily find me the answer on the internal rate of return for this particular assignment. It's very easy, it's the easiest. All I want you to do, in fact, the question is right there. You can buy a turbo-powered machine 2 gadget for 4,000. The investment would generate 2,000 and 4,000 in cash flows for 2 years, respectively. What is the internal rate of return on this investment? I want you to use the next few minutes, do that, okay? When you're stuck, just let me know, and then tell me your answer. All right, okay. So let's look at the resulting remark. Oh, come on. So this is it, okay? So what you do is first, I give you these values, so you just put in the values. The first value was negative 4,000. Then you have 2,000 and then 4,000. Those were the cash flows. The internal rate of return is calculated as NPF.IRR, then into bracket, the cash flows you've already listed. Okay. Now, whatever you are going to get, you convert that to percentage by multiplying it by 100. So this will give you the IRR itself and then the internal rate of return. So now you have the two results. This is the 0.28 and multiply by 100, you get 28%. So this is the rate at which the net present value of buying a turbo-powered machine. The investment is going to generate 2,000 and 4,000 in cash flows every 2 years. The interest rate that will make the net present value zero is 28%. That is basically how you calculate this. Now, there is another kind of interest rate which is known as modified IRR. Now, there's a bit of difference between the modified IRR and then the internal IRR, the internal rate of return. I've put a table here for you to look at the two. Because sometimes the internal rate of return can be misleading because of unrealistic investment assumptions. Whereas the modified one provides a better measure of profitability, which is more realistic. So look at that. But the main difference is that the IRR is the interest rate at which the net present value is zero. The modified one is the interest rate that assumes a reinvestment at a specified rate. Okay. Let's try and get a bit of details. When you have this is an internal rate of return. That's the IRR. Okay. Where you have the sum of the cash flows minus the initial investment, which gives you the net present value. When that is zero, you have the IRR. Numerically, you use try and error, okay, to find the IRR normally. But the MIRR overcomes that guesswork, by incorporating separate rates. And there are two rates it includes. The financing rate, which is a rate at which the negative of the cash flow, that is a cost, are discounted. So you have a different way you discount the cost, and then you have a different way of discounting the profit. So, and that profit one is known as reinvestment rate. So the rate at which the positive, not the negative cash flow, the positive cash flows are reinvested, and then the negative cash flows are discounted. So those two rates helps you to overcome that try and error approach. What is the calculation for the MIRR? It is simply the future value of the positive cash flows by the present value of the negative cash flows raised to the power 1 over the number of periods, all minus 1. This is the MIRR. Okay. Now, in Python, this is the method you use. You use MIRR. You indicate all the values, which is what the IRR would have done. The IRR would have just taken all these. That's all. And that's it. But the MIRR will now include the financing rate and the reinvestment rate. And then it will now calculate the proper discount rate. Let's take an example. Calculate the internal rate of return and then modify the internal rate of return of a project with the following cash flows and show graphically the difference between the two. So you have the initial investment of 10,000 is negative. From cash flow 1 to 4, you have 4, 3, 5, 2,000. Now, the what do you call it? The financing rate, which is also called the WACC, okay, or the weighted cost of capital. That financing rate is 10% here. The reinvestment rate is 12%. So with these two, you can be able to now find the rest. So how do you go by this? Let's go back to our results. I'm just going to show you, and you have the code to work it out on your own. So this is it. You just use the formula here to do the calculation. Okay. So remember the cash flows are there. So the NPV dot MIR is going to be all the values, which is the cash flows. Then the financing rate, which is that a correct one? It's 10%, right? I've written 1%. So it's supposed to be 10%. It's a 10%. And then you run that. In fact, you can do that in yours right now. Okay. I want to, since I've changed it, and I need to reignite my Panda, one of you should do that and quickly tell me the result. Because I use 1% instead of 10%. So obviously I'm going to get 14%, but I shouldn't get 14%. So which one of you can quickly run this and tell me your result? Is somebody doing it? Got the light there? Okay, so you try it. Do it, and then you let me know. But then it should be. Sorry?
0.14157.
Oh, okay. Then, so how come? You use 10%.
10%, yes.
For the financing rate.
Yes.
And 12% for the reinvestment rate.
Yes.
And you still had 14.15%.
I did. So you can rerun yours again and see.
Mine?
Yes.
Well, I told you that if I run, it's not going to work. Okay, let's see. Because okay. Yeah, the end float is still coming, but you still get the value, 14.15.
Yeah.
All right, okay. That's fine. That's okay. All right. Another way you can do it is this. Now, the second part. The second part is to show graphically. So to show graphically, this is it. You have the cash flows, you have the finance rate, you have the reinvestment rate. Okay. You compute the IRR just as we have done before. And then you indicate that the negative cash flows is going to be CF if the cash flows are zero or if they are positive. If they are negative, then you are going to call them negative cash flows. Okay. Otherwise, it becomes a positive cash flows. So the present value of the negative cash flow and the future value, remember the formula we used for the MIR. The present value of the negative cash flow and the future value of the positive cash flow. This was the formula we had for the MIR, because remember, this is a formula. The future value of the positive cash flow divided by the present value of the negative cash flow. But because we are dealing with, we are taking away the negativity, so we take the absolute value. Okay. Then raised to the power 1 divided by the period. So this is going to pick the number of periods that we have. We have how many periods? We had, I think, 4 periods or 5. Then that minus 1, and that will give you the MIRR. You run the result, and that will give you the MIRR result. Okay, put that one somewhere. Then we can now generate the graph. Once again, we use a range of between 0 to 30%. Why are we doing that? Well, remember that the financing rate is 10%, and then the discount rate is 12%. So we are stretching it as far as we can get. We calculate the net present value of the cash flows using the discount rate that we have actually created. We can now plot the net present value profile, which is a downward sloping curve, indicate all the other elements we are supposed to indicate. We mark the IRR and the MIR from the graph by using these commands. We've done it before. We create a legend, and then we show this result. So watch this. The net present value, when it is 0, okay, is there. This is the net present value profile, the blue one, and you have the IRR, which is a green vertical line, which is higher than the MIR, which is lower. And the MIR was calculated from above here. We did that calculation here. Okay. And then you can see clearly that the IRR is higher than the MIR. Okay. So in this case, we have been able to show that the present value. So Remember, the MIRR is not when the net present value is equal to 0. It's not the break-even point of the net present value. It is an IRR. It's not the MIR. So if the MIR is lower, at the point when the net present value is 0, look at the value of the, how do you put it? At a point where the net present value is 0, which is where the IRR is found, you can see that this value is below, the MIR is below that value. That's IRR value in this context. And at a point, yes. Oh, yeah, asking a question.
No, I was agreeing to what you said.
Yeah. So that shows that the MIR is truly good in practical terms than the IRR. Normally, this is very good when you want to know your personal interest rate and you want to do a proper capital budget. That is how you do it. Okay. So when we meet next time, what we are going to do is we are going to calculate, we're going to complete all of this with two more. It's called the payback period and the profitability index. These two are used to determine the project, whether to undertake a project or not to undertake a project. Now, let me ask you a question in conclusion. Which one will you use in making your decision of a project? Is it the IRR or the MIR? Is it the IRR or the MIR? Which one will you use in deciding undertaking a project? Yeah, got it.
I'll take the MIRR. I think it corrects most of the limitations to the IRR, especially
Very
issues of the
excellent.